Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. In the last video, we talked about the huge distribution pattern we have on the NASDAQ 100 to the S&P 500 ratio, and the fact that if this pattern, the Wyckoff distribution pattern we have, plays out according to plan, we could see a significant drop in the technology sector relative to the broader market. So how does that fit in with the overall picture we have on the stock market, which we've said multiple times looks incredibly bullish, right? We've had a long-term breakout above this huge long-term price channel. This is the type of development that institutions look at to determine future expected returns. So how would a sell-off in the tech sector affect the broader market? That's what we're going to talk about in this video. If you are new here, make sure to smash that subscribe button because I'll be here helping you navigate through this crazy market every step of the way. Now, without further ado, let's get right into it. So let's start off by talking about the relationship between this ratio right here of tech performance to the actual broad market. So we've talked about this before. I'm going to put up the S&P 500 on top of this chart so we can actually compare the two charts. And we've discussed a few times the fact that drawdowns in this ratio correspond to drawdowns in the stock market, right? Tech tends to pull down the rest of the market when it underperforms. Same thing right here. A correction in this ratio corresponds to a correction in the market. So if we do see a significant drawdown in this ratio, which is something that we currently are placing higher odds on than before. Now, if the ratio begins to move up here through this trend line and through this resistance, that changes the entire picture. We'd flip to bullish on the tech sector and expect more upside. But right now, we're still clearly at resistance with a general bearish pattern, and it could cause some volatility in the short term on the S&P 500. So that's exactly what we're going to discuss. If this pattern plays out, we could see a correction back down to this zone right here. So from current levels, that would be around a 7 to 8% underperformance of the tech sector, which I can tell you hurts a lot if you're on the wrong side of that trade. The entire goal of investing is to beat the markets. If you're holding tech stocks throughout this kind of move right here, that does significantly hurt your performance. So that would be a similar drop to what we had right there. Let's measure that up from this top right here to the bottom. That was an 8 to 9% underperformance of tech. And that led to a around 4% correction on the actual S&P 500. So looking at the S&P 500 right here from current levels, that would take us down just below this line of support here. So that would be the maximum type of drawdown we could see. So we wouldn't expect a drawdown further than the 4,000 point level right here. So that would be our maximum type of drawdown if we see that type of sell-off in the tech sector. Now, if we do get that type of move like this, we'd expect to see a quick snapback above that level right there, because you're going to see tech pull down the broad market, but all of a sudden sectors like the energy sector, small caps, and the healthcare sector, that's starting to look really attractive. Those sectors are going to start rallying and you're going to see a snapback above. Remember, this is still the same high liquidity, easy money market. Right now, we're not expecting any type of huge correction on the S&P 500. Now, after the recent weak report on non-farm payrolls, it's showing the economy is still struggling to recover. And that does diminish the odds of seeing the Federal Reserve begin to taper their monetary policy. So that is generally a good thing for the equity markets, and it's good for precious metals as well. But we could see some short-term volatility. That's something we said as soon as we started to break out right there above that long-term channel, that we'd likely be back testing this channel for quite a while before resuming the big rally. So that's exactly what's happening right now. It's completely normal. It was definitely the perfect moment to be buying the dip right here, as we talked about in this article we posted for our members on gameoftrades.net, where we talked about the VIX being at resistance, the put call ratio being high, and just a great opportunity to be buying the S&P 500. If you're interested in these kinds of trade ideas, trade setups where we provide specific entries, targets, stop losses, and where we give you guys updates along the way on how the trade's going, whether we need to adjust our stop loss, adjust our targets, whether anything has changed fundamentally or technically, make sure to go and check out our website at gameoftrades.net. So it was a good idea to be buying the dip at this moment, but now not so much, because you've got that additional risk from the tech performance ratio that's testing resistance. So that's generally bearish and could cause some short-term volatility in the markets. But you've also got the VIX near support. That's something we talked about in one of the previous videos. So the risk reward ratio is much less favorable here than it was right there when we talked about buying the dip. You've got a lot more room for volatility to increase here than you did right there at resistance. So while the overall structure of the S&P 500 does look bullish, it's still looking like a perfect setup right here on that long-term breakout and backtest. But if you're looking for high probability short-term opportunities for swing trades, this is not so much a good opportunity. If you're not yet on that trade, you might want to wait for a little bit more tech-fueled volatility before entering the market. Now, speaking of tech, again, we've discussed the ratio. We've taken a look at the distribution pattern relative to the S&P 500, but what does the actual chart say? What does the NASDAQ 100 price action tell us? And this is where I know this video is going to get a little bit more controversial, because some people just don't want to hear about these kinds of patterns forming and are likely not to agree with the validity of that pattern. But we do have a potential head and shoulder pattern here. Now, it's not very clean and it is definitely not confirmed yet, but that doesn't matter. The actual pattern doesn't matter. What matters is the specific characteristics that tell us whether this is more likely to be a period of consolidation before resuming the uptrend, right? Testing that 100-day moving average before continuing on higher, or whether this looks more like a topping pattern. So we're going to quickly talk about that. But first of all, in terms of the actual pattern, you can see this neckline is not well defined at all. We've got daily closes here below that neckline, so that kind of invalidates it. But if we jump to a weekly chart, that's where things get a little bit more interesting. And here it is. You can see that same neckline, but you can see weekly closes don't actually cross that neckline. So we have wicks under that neckline, but ultimately the candles close on it. So you can see the left shoulder, the head, you've got another test of the neckline right there, and the right shoulder that is potentially forming. So let's get back to a daily chart. And here's where things start to get interesting. And by the way, this is something that's only been really starting to form very recently. And that shows you the importance of keeping an open mind when you are trading, and stay flexible and be ready to change your outlook when you're trading, when the charts change. We were very bullish on the NASDAQ 100 when we had that test of the moving average, where we had that snapback, powerful snapback above the 100-day moving average, and we had that nice impulsive breakout here above that trend line. In fact, we are still just above the 100-day moving average, so don't try and short tech while it's still trending up. We still need more confirmation before we can expect more downside on the tech sector. But now let's take a look at some of the signs that we're seeing. Let's put up the volume here, and you can see on that rally leading up to the very top, you've got very low volume leading up to that top, so not much demand for tech, and you've got a rise in volume in that leg down from the head of the head and shoulder pattern. So that's one of the characteristics. You've got rise in volume while price declines. That tends to be bearish. Then you've got a powerful slowdown when you get that right shoulder being formed. And then the last big element is that last leg down back to the neckline, where you've got another rise in volume. So we're going to see what happens in the next few days, if we get a correction and if that has a lot of volume or not. Now, if we break once again back below the 100-day moving average, that's starting to look like more of a bearish setup. We've had already two separate tests very recently, seeing another break of that moving average would show the tech sector is really struggling to stay in that uptrend. Now, hypothetically, if we do get that correction down to the neckline and we begin breaking down here, where could that take us in the tech sector? You measure up the height of the head right there, and that gives you the measured target from the break of the trend line, which could take us all the way down to these levels of support at around 12,000 points. So it wouldn't be the end of the world, but it would be a pretty large correction, especially if we see the S&P 500 hold up, which is something that we absolutely expect to happen if we get that type of drawdown in the NASDAQ 100. We expect the general stock market to hold up relatively well despite this drawdown. So that would just be devastating to anyone holding tech stocks and not the rest of the market. So the conclusion from all this, watch what happens with this ratio. It's going to determine a lot of what's to come with the markets. If this continues going down, you can expect some volatility on the broad market, but it's very likely to be muted because the other sectors are going to hold up the markets. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash that like button. Also, subscribe if you haven't already. In the meantime, good luck on your trading and see you next time.